Let's talk about the 2008 financial crisis. It's an event that didn't just rattle the stock market, it completely reshaped the world we live in. So the big question is, what really happened? Let's get into it.
One day. That's what it came down to. August 9th, 2007. According to the CEO of a huge British bank at the time, that was the day the world changed. A single date that kicked off a chain reaction that would bring the entire global economy to its knees. So how in the world could things change that fast? This wasn't some slow, gradual decline. It was more like a free fall. Let's take a look at the timeline, and you'll see just how quickly everything started to fall apart. I mean, look at this. The year 2008 was just relentless. In March, you have the investment bank Bear Stearns needing a last-minute rescue. But by September, it's a full-on meltdown. First, the U.S. government has to nationalize Fannie Mae and Freddie Mac, these massive players in the mortgage market. Then, the big one, Lehman Brothers goes bankrupt. And just one day after that, the insurance giant AIG needs an $85 billion bailout just to survive. It was like a financial earthquake with aftershocks every single day.
And this wasn't just some abstract thing happening in corporate boardrooms. The panic was real, and it was hitting the streets. Over in the UK, people started lining up outside a bank called Northern Rock, desperate to pull their money out. This was the first time that had happened in Britain in 150 years. I mean, it was a scene straight out of the Great Depression.
So, the big question is, how did we get here? It felt like it came out of nowhere, but the truth is, the ingredients for this disaster had been simmering for years. Let's pull back the curtain and look at the recipe. Okay, so the main cause? It all started with a housing bubble. And we're not just talking about any bubble. According to our source material, this was the largest property bubble in all of human history, and its epicenter was right in the US. And if you want to see what that bubble looked like, well, this chart tells the whole story. You can see back in 1997, things were pretty stable. But then, whoosh, prices just skyrocket, hitting this crazy, unsustainable peak in 2007. And then the bubble burst, and prices just cratered by 2012. The sheer scale of that boom and bust is really the foundation for everything that came next. So what was feeding this beast? Simple. Debt. Just a mind-boggling amount of it. In only 6 years, the average American family's mortgage debt jumped by more than $50,000. That was the fuel for this raging fire. Now, a key ingredient here was something called a subprime mortgage. Put simply, these were really risky loans given to people with poor credit, people who, in normal times, probably wouldn't have qualified for a mortgage. It's like the lending standards were just thrown out the window to get more and more people into the market.
Okay, so you might be wondering, how did a bunch of bad loans made to individual homeowners in America infect the entire global financial system? Well, the answer is a fancy-sounding process called securitization. Banks would take thousands of these mortgages, slice them up, dice them, and repackage them into these complex new products that they sold to investors all over the world. This whole thing created a brand new business model called originate and distribute. So a bank makes a loan, they package it up, and then they sell it off. Now that last step is absolutely crucial, because when the bank sold the loan, they also sold the risk. All of a sudden, they had no skin in the game. There was zero incentive for them to care if the borrower could actually pay the money back. So we've got the recipe, right? A massive housing bubble, a ton of risky subprime loans, and this new system that was designed to spread that risk all over the globe. So let's see what happened when the first domino finally tipped over. And this brings us right back to that date we started with, August 9th, 2007. A major French bank, BNP Paribas, suddenly froze its funds, and they blamed problems with U.S. subprime mortgages. Well, that was it. Investors everywhere panicked, realizing that all those complex securities they'd bought might be loaded with toxic, worthless loans. The entire system just seized up. Trust evaporated overnight, and nobody was willing to lend money to anybody. For about a year, it was this slow-motion train wreck. But the bankruptcy of Lehman Brothers in September 2008, that was the tipping point. The U.S. government decided not to save them, and that single decision sent a shockwave of pure terror through the global system. It turned a really bad situation into an absolute catastrophe. It's hard to even wrap your head around the scale of the response that was needed. To stop a complete and total collapse, the U.S. government had to step in with a $700 billion bailout program called TARP. And these kinds of massive rescue packages were happening all over the world.
Okay, so they managed to stop the immediate collapse. But the crisis left behind a deep, painful, and very long hangover, with consequences that honestly are still shaping our world today.
So the first major consequence, all that bailout money had to come from somewhere, right? Well, governments around the world took on staggering amounts of debt to save their banks. Essentially, the risk was shifted from private companies onto the public, onto taxpayers.
And you can see the impact crystal clear on this chart from the UK. I mean, just look at that massive jump in public debt in just a few years. In order to save the banks, governments basically had to absorb this incredible financial shock themselves. And to deal with all this new debt, governments turned to a policy that came to be known as austerity. This meant a long, painful period of deep cuts to public services, things like healthcare, education, local government, and it went on for years. But this austerity policy had some really surprising political consequences. Our source material points to a pretty stunning connection. The parts of the UK that were hit the hardest by these spending cuts were often the very same areas that later voted most strongly for Brexit. The economic crisis was now literally redrawing the political map. The other big response came from central banks. To try to get the economy moving again, they slashed interest rates down to basically zero. Now, this was supposed to be a temporary emergency measure, but it ended up becoming the new normal for more than a decade. So, after living through the crash and its decade-long hangover, what are the big lessons? What should we take away from all of this? Well, 3 lessons really stand out. First, that banking crises are just devastatingly expensive for everybody in society, not just the banks. Second, we learned about the very real danger of regulatory capture. That's when the regulators start acting more like they work for the industry they're supposed to be policing. And finally, that regulators have to be independent enough to stand up to political pressure and just say no, even when there's a huge push for a light touch. And all of this brings us to one final, pretty unsettling question. The 2008 crisis was fueled by a decade of easy money and low interest rates. Well, we've just lived through another, even longer, period of exactly the same thing. So the question we really have to ask ourselves now is, are we ready for what comes next?